The VIX just pulled a fever spike that hasn't been seen since April's inflation scare, and every tech holding is now running hot against the tailwind of risk rotation. A 2-year rally let many investors retire early at 62. Now they're claiming Social Security to lock in gains, even if it costs them for life. The data is screaming, this isn't a crash signal, but it's an immunity-building day, where portfolios shed speculative weight before the Fed's next move. The greed meter is running hot at 68%, down from yesterday's 74% peak, as tech capital rotates out of speculation and into defensive positioning. Our proprietary risk reward oscillator shows spec leaders like ARKK coughing through a 2.82% session, while the Magnificent 7 MAGs barely scratched 0.06%. The consensus among the Canary community is that this isn't fear selling. It's profit-taking after 2 years of vertical gains, with the S&P 500 retreating from its August highs as investors recalibrate exposure ahead of quarterly earnings season. The credit pulse is steady at 72,100, showing no distress but confirming what the headlines are screaming about. Risk capital is flowing away from speculative bets like quantum computing. Quantum stocks unwound a revenue headline rally with Rigetti down 7 pearls and drone tech. Unusual machines tumbled 9. Our high-yield monitor shows HYG flat, while KRE regional banks barely moved at 0.12%, which means the banking system isn't bleeding. This is portfolio-level rebalancing, not sector-wide infection. The indicators are signaling that credit spreads remain tight enough to support a soft landing scenario, but duration-sensitive assets like TLT, 0.66, are already pricing in rate stability. The fear gauge spiked plus 4.55% on the VIX alone. Our proprietary volatility infection index now sits at 18.2%, which is a mild fever, not cardiac distress. UVXY, VIXY, and VXX all drifted up modestly as hedgers bought insurance before midday close. But this isn't panic buying. It's defensive positioning after the Marvell. Broadcom semiconductor positioning shift. The data confirms what every tech investor knows. Quantum computing and drone stocks are cyclical overheat conditions that cool off quickly once revenue headlines fade. Our metrics show fear is concentrated in growth at any cost sectors while value holds steady. This is how a portfolio builds immunity. The real economy signal shows inflation cooling but not dead. The headline about Social Security claiming costs reflects investors locking gains at their peak, which means future consumption could dip if retirees downsize portfolios to protect capital. Oil's 2.37% drop and gold's 0.60% rally create a classic risk-off copycat hedge pattern when energy becomes expensive again. As geopolitical tensions around Iran sanctions intensify, consumers cut discretionary spending first, hence XLP consumer staples 1.65 outperforming everything else. The 10Y Treasury yield dipping to 4.7% means rate expectations are stabilizing, which is exactly what the real economy scoreboard needs to show before Fed policy shifts again. The safety trade isn't a trade, it's survival. GLD Gold 0.84 pulses and TLT long-term Treasury 0.66 barrels are building immunity against whatever geopolitical shock the Iran sanctions headlines will unleash next week. Our defensive rotation index shows capital flowing from speculative tech, SMH2, 29 mirrors into staples, bonds, and commodities, the classic portfolio flu pattern where you isolate infected assets before they spread to healthy holdings. The consensus among Canary subscribers is that safety isn't about going all in on gold or treasuries. It's about duration management. TLT outperforming bond, because inflation expectations are cooling but not dead yet. The hero today is your portfolio shedding speculative weight before the Fed's next pivot. And the villain is complacency, the belief that 2 years of gains means immunity from rotation. The data confirms what every sector metric screams. Tech isn't crashing, it's building antibodies against overvaluation. Quantum computing, drone stocks, and even semiconductor positioning shifts are just symptoms. A mild infection that resolves with proper dosage management, reducing spec exposure while maintaining core positions. The S&P 500 dropping 0.28%, while the Dow climbs +0.26% proves this is a rebalancing day, not an exit signal. Your portfolio needs to do what investors are doing: lock in gains, protect duration, and let time heal any microinfections before they compound into systemic stress. The Canary dashboard shows fear building but infection contained. This is how portfolios survive multi-year rallies, by shedding speculative weight when headlines scream overheated. Hold core positions while trimming the feverish assets that are running hot today, and let your duration management do the heavy lifting before next week's geopolitical headlines hit. The data confirms what our metrics have been singing all day. Patience beats panic every time a VIX spike hits 1582.